Gold hit an all-time high of $5,450 an ounce in January. Then the Middle East exploded, oil surged, and inflation fears spiked. Every textbook says that's when gold climbs. Instead, it dropped 20%. Here's what actually happened and what comes next. If you're holding gold or silver right now and watching your position turn red, while the news cycles through war and oil shocks and inflation warnings, this video is for you specifically. Not to tell you to panic, not to tell you everything is fine, but to explain the exact mechanism behind what you're seeing so you never misread a crisis sell-off again. JP Morgan has a year-end price target for gold of $6,300 an ounce. Deutsche Bank is at $6,000. BNP Paribas has a peak above $6,250. These aren't fringe predictions from YouTube channels. They are the publicly stated targets of the three largest financial institutions in the world, set after the January high, not before it. Here's the thing that breaks people's mental model. Gold doesn't respond to crisis headlines. It responds to interest rates. And specifically, it responds to the opportunity cost of holding something that pays you nothing. Think about what you can earn right now on a 6-month Treasury bill, somewhere between 4.5 and 5%. Put $10,000 in today, earn roughly $450 over the next year, doing nothing with zero risk. Gold, by contrast, pays you exactly zero. No coupon, no dividend, no yield. It just sits there. When rates stay high or rise higher, every dollar sitting in gold is a dollar that isn't earning a guaranteed return somewhere else. Wall Street recalculates that spread constantly, and when the spread widens, the sell orders follow. The Iran war didn't make gold drop. It made inflation expectations jump. Inflation expectations killed the Fed rate cut that traders had been pricing in. The rate cut disappearing is what made gold drop. The war was the trigger. Rates were the mechanism. Here's the layer most people miss completely. When inflation fears spike globally, investors don't just sell gold, they run to the US dollar. Not because the dollar is in great shape, but because it's still the world's panic room. Money pours in from pension funds in Japan, central banks in Europe, sovereign wealth funds across Asia. All of them buy dollars first. That dollar demand pushes the dollar's value up. And gold is priced in dollars globally, which means a stronger dollar makes gold more expensive for every buyer outside the United States. International demand gets suppressed at the exact moment you'd expect it to surge. So what you actually get in a crisis sell-off is three forces landing simultaneously. First, higher bond yields raise the opportunity cost of holding gold. The math of owning something with zero yield gets worse when alternatives start paying 5%. Second, a stronger dollar suppresses international demand. A European fund, a Japanese institution, a Brazilian central bank, they're all seeing gold cost more in their local currency even when the dollar price barely moves. Third, institutional profit-taking. The investors who got in during 2024 when gold was trading around $2,000 an ounce are sitting on extraordinary gains. Rising rates gave them somewhere else to park that profit. So they sell, and that selling hits the tape during a crisis, looks like institutional abandonment, and triggers a wave of retail panic on top of it. It isn't abandonment, it's profit-taking in a bull market that hasn't ended. These three forces together are what a pullback in the middle of a crisis actually looks like. This exact sequence has repeated across every major oil shock of the last 50 years. October 1973, OPEC embargo, oil spikes. Gold initially drops, then stages a historic multi-year rally. 1979, Iranian Revolution. Oil collapses. Gold drifts for months, then gains roughly 89% over the following year. 1991, Gulf War, Iraq invades Kuwait. Gold pops briefly, trades sideways, then recovers strongly once the immediate shock resolves. 2001, September 11th, gold begins a decade-long run from $250 an ounce to nearly $2,000. 2022, Ukraine invasion. Gold breaks $2,000 for the first time and holds it. Every single instance, the same pattern. Initial shock, confusing pullback that feels like failure. Then structural recovery to prices significantly higher than before the crisis started. The people who understand the mechanism hold through the pullback. The people who don't sell into it. Here's what makes today's setup structurally different from every previous episode. When the 1973 oil shock hit, US national debt was around $500 billion. Today it's $39 trillion. The government is spending $1 trillion a year just on interest, more than the entire defense budget. The Congressional Budget Office projects that number climbs to $2 trillion within a decade. Meanwhile, central banks around the world bought 244 tons of gold in the first quarter of 2026 alone. Poland's central bank added 31 tons in a single quarter. China extended a buying streak, now running 18 consecutive months. These institutions are not buying gold because of a war. They're buying because they've made a structural decision to reduce their exposure to US dollar-denominated assets. That decision was in place before the Iran conflict added a single dollar of geopolitical premium on top of it. The conflict is an accelerant. The structural shift was already there. Here's the number that connects everything. The United States is currently paying $3 billion a day in interest on the national debt. Every day. That's not a temporary condition. That's the baseline, and it's growing. When sovereign debt reaches this scale, the appeal of hard assets that can't be printed becomes structural, not cyclical. There's one technical indicator every major institution watches during these moments: the 200-day moving average. Think of it as gold's long-run price baseline. The average of the last 200 trading sessions smoothed out. Right now, gold is trading close to that line, around $4,400 an ounce. Historically, when gold reaches this proximity to or below its 200-day average following a geopolitical shock, it has preceded recoveries of significant magnitude. The last time gold traded at a similar gap below its 200-day average was 2022, when the metal was around $1,500 to $1,600. The people who held through that pit, or added to their positions, saw gold nearly triple to its January high. That's not a guarantee. It's a pattern that has repeated consistently enough to be worth understanding. Here's the key distinction that separates this pullback from a structural breakdown. Every force currently suppressing gold, high bond yields, a strong dollar, institutional profit-taking, is temporary. The Fed will eventually cut rates. The dollar will eventually ease. The profit takers will eventually be replaced by the next wave of buyers. The forces driving gold's structural case are not temporary. $39 trillion in debt doesn't resolve quickly. A global shift by central banks away from dollar reserves doesn't reverse in a quarter. A geopolitical environment that has permanently changed how sovereign nations think about reserve assets doesn't reset because a ceasefire is signed. The temporary forces push down, the permanent forces point up. When the temporary forces lift, the permanent ones reassert. Here's the question worth sitting with. If central banks, the most cautious, slowest moving institutional buyers on earth, are purchasing gold at the fastest pace in modern history, what do they know that the retail panic sellers in a crisis don't? They know that a pullback driven by bond yields and dollar strength is mechanical. It's the same mechanism that has appeared after every oil shock for 50 years, and it has resolved the same way every time. The question isn't whether gold recovers. The question is whether you're still holding it when it does.